Astonishing, incredible. It's amazing, even I was astonished. What are the steps to predicting so accurately? It's exciting for me to share this magical method and secret with you. The process of reducing rates is not yet necessary. From last year, we have not been expecting or evaluating the implementation of U.S. Federal Reserve's easing policies in the videos on this channel. The Yi-Jing, or Book of Changes, indicate that the process of cutting rates has not been started, which is why this happens. The stock market, a seductive siren, luring investors with the promise of untold riches. It's easy to be enchanted by stories of overnight millionaires and skyrocketing stock prices. Who wouldn't want to dive headfirst into this glittering pool of wealth? But beware, for this temptation often leads to irrational decisions driven by greed and the fear of missing out. The stock market can be a seductive mistress, promising wealth and prosperity. It beckons with the allure of easy money, especially during times of exuberance and optimism. Stories of overnight millionaires, fueled by speculative bets and market frenzy, tantalize both seasoned investors and newcomers alike. The temptation to ride the wave of market euphoria can be intoxicating, often leading to irrational decisions driven by greed and the fear of missing out. Hello everyone. Welcome to our channel. In today's video, we'll unravel the ancient wisdom of the Shānfēng Gǔ hexagram and its surprising relevance to modern investing. Whether you're a seasoned investor or just starting, this video will provide you with valuable insights to navigate the volatile world of stocks. Stay tuned, and don't forget to like, subscribe, and hit the notification bell for more fascinating content. Just as the Shānfēng Gǔ hexagram narrates the fall and subsequent revival of a family's fortunes, so too does the stock market reflect cycles of exuberance and decline. The hexagram's message is clear. Awareness of decay is crucial, and action must be taken before the rot sets in irreparably. The symbolism extends to modern management practices, urging leaders to identify issues early and implement corrective measures. The Shānfēng Gǔ hexagram, a cornerstone of the Yi-Jing, or Book of Changes, has been studied and interpreted for centuries. It's a tale as old as time. When the head of a family falters, the responsibility falls to the next generation to rebuild and restore. In the ancient script, Shānfēng Gǔ hexagram suggests corruption, but also the necessary action to rectify such corruption. The hexagram teaches that recognizing and addressing decay is the first step toward restoration. The annals of financial history are littered with cautionary tales of market bubbles. These episodes serve as stark reminders of the dangers of unchecked greed and the devastating consequences that follow. One of the earliest and most infamous examples is the Dutch Tulip Mania of the 17th century. Tulips, once a rarity, became a highly sought-after commodity, with prices soaring to astronomical levels. Fueled by speculation and the belief that tulip prices would rise indefinitely, people mortgaged their homes and invested their life savings in these exotic flowers. At the peak of the mania, a single tulip bulb could fetch the price of a grand Amsterdam canal house. However, the bubble eventually burst, sending prices crashing down and leaving countless investors financially ruined. To truly understand market dynamics, one must delve into the intricate interplay of fear and greed, two powerful emotions that exert a profound influence on investor behavior. These emotions, often operating at a subconscious level, drive market cycles, creating periods of irrational exuberance followed by bouts of paralyzing fear. Greed, the insatiable desire for more, fuels market booms. It entices investors with the promise of quick riches, encouraging them to take on excessive risk in pursuit of outsized returns. When greed reigns supreme, investors often overlook warning signs, dismiss dissenting opinions, and engage in herd-like behavior, driving asset prices to unsustainable levels. Fear, on the other hand, emerges during market downturns, casting a long shadow of doubt and uncertainty. As asset prices decline, investors panic, selling their holdings to avoid further losses. This mass exodus exacerbates the downward spiral, creating a self-fulfilling prophecy of fear and despair. The interplay of fear and greed creates a cyclical pattern in market movements. Periods of greed and optimism characterized by rising asset prices and speculative bubbles, are inevitably followed by periods of fear and pessimism, marked by market corrections, crashes, and economic downturns. Warren Buffett, widely regarded as one of the most successful investors of all time, famously advised, "Be fearful when others are greedy and greedy only when others are fearful." This seemingly simple statement encapsulates a profound investment philosophy, urging investors to resist the sway of market emotions and instead adopt a contrarian approach. Buffett's wisdom lies in recognizing that market sentiment often deviates from rational behavior. When greed dominates, investors tend to overpay for assets, creating bubbles. Conversely, when fear takes hold, they undervalue assets, presenting opportunities for savvy investors to buy at bargain prices. By embracing fear when others are greedy, investors can avoid getting caught in the frenzy of market bubbles and protect their capital from devastating losses. Conversely, by embracing greed when others are fearful, investors can capitalize on market downturns, acquiring undervalued assets that have the potential to generate significant returns over the long term. Buffett's dictum is not a call to blindly go against the grain. It is a call for independent thinking, urging investors to base their decisions on sound analysis, fundamental valuation, and a long-term perspective, rather than succumbing to the emotional roller coaster of market sentiment. Beyond the hype, the importance of independent thinking. In the age of information overload, it's easy to get swept away by the constant barrage of market news, expert opinions, and social media chatter. However, not all information is created equal, and blindly following the crowd can lead to disastrous investment decisions. To navigate the complexities of the market successfully, investors must cultivate independent thinking. Independent thinking requires a critical mindset, questioning assumptions, challenging conventional wisdom, and seeking out diverse perspectives. It involves digging deeper, looking beyond the headlines, and conducting thorough research to form your own informed opinions. This includes understanding the fundamentals of businesses, analyzing financial statements, and evaluating the long-term sustainability of their business models. Don't be afraid to challenge the consensus view, even if it means going against the grain. Some of the greatest investors in history have made their fortunes by thinking differently and identifying opportunities that others overlooked or dismissed. Remember, the market is not always right, and what is popular is not always profitable. Developing independent thinking is an ongoing process, requiring constant learning, adaptation, and a willingness to challenge your own biases. By cultivating this essential skill, you'll be better equipped to navigate the complexities of the market, make sound investment decisions, and achieve your financial goals. The perils of herd mentality, why we follow the crowd. Humans are social creatures, hardwired to seek safety and belonging within a group. This innate desire to conform often spills over into our financial decisions, leading to a phenomenon known as herd mentality. In the context of investing, herd mentality refers to the tendency of individuals to follow the actions of the majority, regardless of whether those actions are rational or in their best interest. Herd mentality can be particularly dangerous in financial markets, where it can exacerbate both bull and bear markets. During periods of market euphoria, herd mentality drives asset prices to unsustainable levels as investors, fearing they'll miss out on quick profits, pile into overvalued assets. Conversely, during market downturns, herd mentality can lead to panic selling, driving prices down further and turning a correction into a full-blown crash. There are several psychological factors that contribute to herd mentality in investing. These include information cascades, relying on others' actions as a shortcut to decision-making; social proof, believing that if everyone else is doing it, it must be right; and emotional contagion, allowing the fear and greed of others to influence our own emotions. Recognizing and mitigating the influence of herd mentality is crucial for making sound investment decisions. By developing independent thinking, conducting thorough research, and focusing on your own investment goals and risk tolerance, you can resist the urge to follow the crowd and instead chart your own course in the market. Navigating the emotional roller coaster strategies for prudent investing. Investing by its very nature is an emotional roller coaster. Market fluctuations, economic uncertainty, and the constant barrage of news can trigger a range of emotions, from euphoria and greed to fear and panic. Learning to manage these emotions is crucial for making rational decisions and achieving long-term investment success. One of the most effective strategies for managing emotions is to have a well-defined investment plan. A solid plan outlines your investment goals, risk tolerance, and time horizon, providing a roadmap for navigating market volatility. It serves as an anchor during turbulent times, reminding you of your long-term objectives and preventing you from making impulsive decisions based on short-term market fluctuations. Diversification is another key strategy for mitigating risk and managing emotions. By spreading your investments across different asset classes, sectors, and geographies, you reduce the impact of any single investment on your overall portfolio. This helps to cushion your portfolio against market volatility and provides peace of mind during periods of market uncertainty. Finally, remember that investing is a marathon, not a sprint. Focus on the long term and avoid getting caught up in the day-to-day noise of the market. Patience, discipline, and a commitment to your investment plan are essential for weathering market storms and achieving your financial goals. In the vast tapestry of Chinese classical texts, few symbols are as rich and multifaceted as the Shānfēng Gǔ hexagram. It speaks of family decline, a son taking up his father's mantle, and the urgent need to rectify and restore the family's fortunes. The characters for Shānfēng Gǔ hexagram depict a vessel with worms hinting at decay, but in the context of the hexagram it also signifies reformation and renewal. From ancient times to the present, this hexagram embodies the cyclical nature of decay and rejuvenation, a theme surprisingly relevant to today's financial markets. Your financial journey. A call for informed decision-making. The world of investing can be both exhilarating and daunting. The potential for wealth creation is undeniable, but so too are the risks. As you embark on your financial journey, remember that knowledge is your most valuable asset. Take the time to educate yourself about different investment strategies, understand the dynamics of the market, and develop a sound investment plan that aligns with your individual goals and risk tolerance. Don't be afraid to seek out professional guidance from a financial advisor who can provide personalized advice and help you navigate the complexities of the market. A good advisor will take the time to understand your financial situation, goals, and risk tolerance, and work with you to develop a tailored investment plan. Remember, investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. Avoid chasing the latest hot stock tip or trying to time the market. Instead, focus on building a diversified portfolio of quality investments that align with your investment horizon and risk appetite. The journey to financial well-being is a marathon, not a sprint. By embracing a mindset of continuous learning, making informed decisions, and staying disciplined in your approach, you can navigate the challenges and opportunities of the market and achieve your long-term financial goals. This channel is based on a humble heart. It's important to always be open to new ideas, continuous learning. The Eastern concepts of heaven and man, Taoism and nature, and the harmony of yin and yang are specifically discussed. Obey the laws that govern the universe. By using neural AI calculations to scrutinize the distinction between the appearance and reality of facts, and emphasize the connection between knowledge and action. Continually learning and improving in practice is key. Combine the ideas learned during previous doctoral studies with the current situation. Do you know? Each region on Earth has its own specific longitude and latitude, as well as its own unique environmental resources. If there are any topics that pique your interest, please leave a message. I would like to express my gratitude to all the viewers for their support at the end of this episode. If you think that today's video has gained some momentum, don't forget to like it so you can find it later when you want to watch it. I want to express my gratitude for your attention. Thank you.